Have you ever considered having an investment advisor? Do you wonder how to carry out due diligence on your investments? Do you know why marketability is so important when investing? In today's video, we are going to talk about these concepts, in our series about the intelligent investor. This is the second video we are making about this bestseller, so be sure to check out the first one, if you haven't already. In the first part of the book, we analyzed the advantages of portfolio diversification, and why having a margin of safety is important. In this second video, we will explain Graham's views on the market fluctuations, and the importance of due diligence and marketability. Let's now have a look at each of these concepts, with some examples to illustrate the principles presented by Graham. First, we are going to go through what Graham calls the investor and market fluctuations. This section explains the dangers of speculative investing, and the importance of being able to withstand market fluctuations. Graham presents us the importance of having a long-term investment horizon, and the dangers of trying to time the market. He also covers the concept of marketability, which refers to how easily an investment can be sold. Graham warns you against speculative investing, because it involves taking on excessive risk in the hope of achieving large, short-term gains. It's more desirable to have a long-term investment horizon, and to focus on building a well-diversified portfolio of high-quality investments. The concept of marketability is, also, important to consider when selecting investments. Marketability refers to how easily an investment can be sold. You should consider marketability when selecting investments, as it can be important in the event that you need to sell those investments quickly. In terms of speculative investing, let's have a look at this example to understand why you should avoid it. Imagine that you are considering investing in a startup company who is developing a new technology. The company's founders are promising high returns on investment, but the technology is untested, and there are no guarantees that it will be successful. Speculative investing, in this situation, might involve investing a large amount of money in this startup, in the hopes of achieving a high return if the technology is successful. However, there is a high risk of loss, if the technology does not pan out as expected. In contrast, a more cautious and defensive approach to investing might involve investing a smaller amount of money in the startup, or not investing in it at all, due to the high level of uncertainty and risk involved. This approach is more conservative, and seeks to minimize the potential for loss. The next concept in this section, marketability, is easily explained with the following illustration. Imagine that you own a collection of rare stamps that you have been collecting for many years. The stamps are highly valuable, and you are planning to sell them in order to fund your retirement. When considering the marketability of your stamps, you should consider factors such as the demand for stamps among collectors, the rarity of your stamps, and the ease with which they can be sold. For example, if you have a rare stamp that is in high demand among collectors, it may be easier to sell than a less rare stamp that is not in as much demand. Similarly, if you have a large collection of stamps that are all relatively common, it may be more difficult to sell them as a group than if you had a smaller, more focused collection of rare stamps. In general, investments that are highly marketable can be easily bought and sold, and are less subject to price fluctuations than less marketable investments. Finally, the fourth and last section of the book covers the investor and his advisors. This section discusses the importance of selecting a good investment advisor, and the various types of investment advisors available. Graham covers the importance of due diligence, and the dangers of relying on advisors' recommendations without properly evaluating them. You should be wary of blindly following an advisor's recommendations, without properly evaluating them, as this can lead to poor investment decisions. There are different types of advisors, such as brokers, financial planners, or investment advisors. As a minimum, before selecting an advisor, you should tell them what your needs and goals are, and discuss the pros and cons of each potential investment they recommend. To expand on due diligence, let's look at this example. Imagine that you are considering investing in a particular company, which your financial advisor recommends as a sure thing. The advisor tells you that the company is well managed, and has strong growth potential, and it also offers to sell you shares at a discounted price. Without doing your own due diligence, you might blindly follow your advisor's recommendation, and invest in it. However, upon further research, you discover that the company is heavily in debt, and has a history of financial mismanagement. If you had done your own due diligence, and carefully evaluated the investment, you would have been able to make an informed decision about investing in it, rather than just following your advisor's recommendations blindly. Also, if you had done your own due diligence, and found that the company was financially sound, and had strong growth potential, you might have decided to follow your advisor's recommendation, and invest in the company, potentially earning a good return on your investment. In general, the importance of due diligence lies in the fact that it will help you make informed decisions, and ultimately, will enable you to avoid risky, or fraudulent investments. In contrast, the dangers of blindly following an advisor's recommendations are that you may make poor investment decisions, or fall victim to fraud. With this illustration of the importance of due diligence, we arrive at the end of the video. In conclusion, by reading and applying the lessons of The Intelligent Investor, you will be well equipped to navigate the stock market, and make informed investment decisions with the potential to produce good returns over the long term. Its enduring principles, such as the importance of diversification, and avoiding speculative investing, will remain relevant for decades to come. Thanks for watching. If you enjoyed this video, and are looking for more insights and advice on personal finance, investing, self-development, and entrepreneurship books, be sure to check out some of our other recommendations. Check out The Richest Man in Babylon, by George Clason. This book is based on a series of parables set in ancient Babylon, and uses these stories to illustrate financial principles and strategies for building wealth. Also, check out The 7 Habits of Highly Effective People, by Stephen Covey. This outstanding book will give you insights in the habits and principles that can help you become more effective and successful in your personal and professional lives. Thanks for watching, and we'll see you in the next video. Adios.